Brooklyn Mad Money. Welcome to Cramer America. Other people make friends. I'm just trying to make a little bit of money here. My job is not just to entertain, but to educate, teach you. Call me, 1-800-743-CNBC. Tweet me at Jim Cramer. I'm going to say it even though it sounds ridiculous. This stock market rallied today because we didn't attack Greenland. We didn't send the 101st Airborne into Copenhagen. President Trump said there ain't going to be no war no more and even promised not to hit our allies with tariffs because he, quote, formed the framework of a future deal, end quote, with the Secretary General of NATO. He's optimistic it will happen and will no doubt, I think, be the best deal ever, even exceeding the Louisiana Purchase. You really can't make this stuff up, can you? Yet it's the truth. As I was waiting to get on TV this morning for Squawk on the Street, the stock futures were weaker. Step by step, inch by inch, they were growing down. Then President Trump spoke, sounding like a man of peace. And then the stocks roared. As I turned to my colleague, David Faber, and I said, Greenland invasion ruled out. Here comes the futures. And that's exactly what happened. It's insane, people. It really is. But the market ultimately finished up today. Dow rocketing 589 points. S&P closing up 1.16%. NASDAQ finishing up 1.18%. As war was tabled, and then a framework for Greenland occupation seems to be in the offing. How the heck did we get to this crazy point? At first, I like to play with an open hand. Let me just say I hate talking politics. It's not in my area of interest or expertise. It's way too polarizing. For most of my professional career, politics didn't really matter. Regulators could matter. Budget deficit could matter. Government shutdowns could matter. Most of the time, though, the president doesn't have much impact on the stock market, at least not on a day-to-day basis. The last president rarely got involved in the markets, except when one of Biden's aides drew up a list of our friends to determine which companies could get NVIDIA's latest chips. His regulators tried to block virtually every merger, too. But the White House itself wasn't regularly moving in the market. The White House, see this? They were oblivious to this place, believe me. Even in President Trump's first term, he didn't directly try to move the averages, except when the economy froze up during COVID. This time, though, Trump, too, is so different. It's crazy. From trade policy to tax policy to capital return policy or military policy, ramifications to the stock market are more important than anything other than the direction of interest rates, both the long rate set by the bond market and the short rate set by the Fed. And remember, Trump wants to set those, too. There are huge stock market reverberations to almost everything this president does, and I think he knows it. I remember when he called the bottom after Liberation Day fracas, literally by posting on Truth Social that it was time to buy stocks, a great time to buy. David Faber and I were on the desk trying to figure out dispassionately what could happen. Well, it turned out the president was right. It was an amazing buying opportunity. Which brings us to the Greenland imbroglio. The president has been stewing over this Greenland issue for a while. We have a lot of history with Greenland. There's a huge U.S. Air Force base built during the Cold War. It's very important to our nation's defense. Some might argue that we should have sovereignty over such a critical base. But Denmark's a member of NATO, and we run NATO. Until very recently, it might as well have been on U.S. soil. But this president doesn't respect Denmark or NATO, for that matter. He seems angry at the whole Scandinavia because he lost out on the Nobel Peace Prize. Look out, Oslo! Enough of the history. Yesterday, we were concerned that Trump might decide to take Greenland by force. The notion that we would actually go to war with our allies over Greenland, of course, was totally absurd. But because this president is willing to use pretty much anything in the U.S. arsenal to get his way, from tariffs to bombings and kidnapping world leaders, sellers took control of yesterday's session. They were scared. Normally, you expect interest rates to go down as people seek the safety of treasuries. Not this time. NATO members own about $3 trillion worth of U.S. bonds. Why they would hold them if they're worried about the United States declaring war on them? No, not going to happen. So sellers swarmed in, dumped treasuries ahead of the pending U.S.-Denmark war. When rates shot up, we saw a frantic move out of high-price-to-earnings multiple tech stocks, as well as anything related to housing. That was really yesterday's market. The latter is brutal, by the way, because there had been hope that the president was going to authorize buying mortgage-backed bonds to bring down rates. Yesterday looked like that way a goner. So even though D.R. Horton, the largest home builder, reported a pretty good quarter, stock got crushed. That was on Greenland. Today, though, we got to take the Greenland worries off the table, not just the possible invasion, but also the threat of tariffs, and Horton then screamed higher. So did Home Depot, which jumped $9.53, or 2.5%. That was the Greenland peace dividend. Of course, not everything went right from the stock market's perspective. The president's also decided to prohibit corporate home buying, something he thinks is needed to get housing prices down. He signed an executive order banning it. Of course, I don't think he has the authority to do that. But like with the tariffs, neither Congress nor the court seems willing to push back or even care. And he reiterated the 10% cap on credit card interest rates, something that I believe would be an economic disaster because the credit card industry would just stop lending. JP Morgan's Jamie Dimon told us that. Still one more area where the congressional action is needed, but you go tell Trump that. I'm not going there. In this world of presidential intervention, you need to know two things. One, the president is the best bully pulpit in the world. And two, he can go to war, but the war only ends. Tonight, we have Joe Wolk, the CFO of Johnson & Johnson, giant pharmaceutical company. The president ran, among other things, on lower drug prices, and then he got them. He also ran on reshoring, got that too. Then it ended, and these drug stocks have had a sensational, well, let's say, run after the peace dividend. Joe Wolk will explain that to us. Is the president's bark worse than his bite? He certainly does a heck of a lot of barking. You can't help that. But you have to try to figure out whether the worst case will really come true. This time, the worst case was an invasion of Greenland. You have to ask yourself if the president's threats are too outlandish to really happen. In this case, the bond market rebelled, and because the president doesn't want to wreck the economy, he changed his mind. He's given you so many buying opportunities in this game of international domestic chicken since he took over that all you got to do is just got to wait for the hot ones and then do some buying. But what really matters here is that you never know when the president and his team are going to strike or what sector will be hammered. Only fossil fuels and the derivatives seem to get the president's unmitigated backing, unless, of course, they're unwilling to pitch in on that Venezuelan rebuild. So here's the bottom line. My goal in this show is not to judge, it's to profit. Unlike the first Trump administration, Trump, too, is far more comfortable taking the market down, not up. Just be ready. You should get plenty of good buying opportunities over the next 3 years. Heaven knows he sure seems to love to provide them. Why don't we go to Sargon in Hawaii? Sargon.
Hi, Jim. How are you doing? Nice talking to you.
Same, Sargon. What's happening?
I have a question about Barrick Gold. So it's two questions. Do you think it's going to go $55 or above? And what's your price prediction for that?
Okay, I like the new management of gold. Now it's called gold.com. But I really prefer you to be an Agnico Eagle. I am a gold bug. I do not trade gold. I own gold. If gold is down, I buy. If gold is up, I don't. Agnico Eagle had a big term today that was down. I think it'll be down again tomorrow, and I'm a buyer. I am a gold bug. Vince in Florida. Vince.
Good evening, Jim. Give me your opinion on JetBlue. Should I hold it or sell it?
I'll tell you, I had a pretty good trip the other day in JetBlue. When I was coming back from San Francisco, the people were really nice. I want to thank them for being so great. Do I want to own the stock? I think United Airlines is amazing. This guy, Scott Kirby, I'm like, he's like so smart. I mean, I got to tell you, that guy is dynamite. But you can't fly there just because the stock's up, but you can buy the stock. Whoa. How about Gabe in California, please? Gabe.
Hello, Jim. Thank you for taking my call.
My pleasure.
You have, so I have this stock. You've been positive on it for quite some time. With the recent turmoil, what are your thoughts on DraftKings?
Okay, it is incredible. I saw a downgrade of Flutter today. DraftKings, I'm waiting. Look, it's got to have these other states. It's got to have Texas, California, and Florida. It just has to. At this point, as long as it doesn't, the stock's not going to go anywhere. I thought they would have, they'd be all on the ballot. I still think so. I don't know. It hasn't happened, and that's been disappointing to me, but it always could. All right. Unlike the last time around, Trump, too, is far more comfortable with taking the market down. You got to get used to that. I'm trying. Man, I tell you, as I mentioned, Johnson & Johnson's earnings were buoyed by positive news out of its cancer fighting division, along with an upbeat forecast. Sitting down with the CEO of the pharma giant and hear about the company's path forward. Ooh, do I like that stock. Then, as goes OpenAI, so goes the data center build-out. I'm taking a look at potential risks to the market if things go sideways for the AI behemoth. And aside from tariff turmoil, one of the biggest risks to the market is the supply of new stock. I'm explaining why that can be a bull killer. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
All right, what do we make of these earnings from Johnson & Johnson? This morning, the Pharma Titan reported a healthy revenue beat and a very modest earnings beat with a strong full-year forecast, which is what I care about. However, the stock was unchanged. Now, it was down much more than that intraday in response to the print, in part because it was up more than 40% last year and had to run up another 5% year-to-date going into the quarter, one of the best pharmas there is. So could this be a buying opportunity? Earlier today, I had a chance to speak with Joe Walk. He's the chief financial officer of Johnson & Johnson. Why don't you take a look? Well, first, thank you for being here on what I think is really a marvelous day for J&J.
It absolutely is, Jim. Thanks for having me. It's an honor to represent Johnson & Johnson coming off a year like 2025 and what really the outlook is for 26 and beyond.
It does seem like 2026, unbelievably, after 25, you're setting up, it's going to be a better year even than last year.
Absolutely. You know, Jim, if we would have sat here last year for 2025, investors had a lot of questions. People in the media had a lot of questions,
yes,
right?
They did.
How are they going to handle the Stelara loss of exclusivity? What's the medtech performance going to be like? Will these new products and pipelines that they talked about emerge? Well, a number of cards turned over, and not only did we get face cards, I think we have some aces in there. You look at pharmaceuticals, now $60 billion in revenue. It grew 8% in the quarter, 5% for the year. That's after absorbing $4.4 billion of Stelara lost sales. Without that impact, the base products, the products that we're going to count on for 26 and beyond, growing around 15%. MedTech, $34 billion. What I loved about their cadence is improving growth each quarter throughout the year. And it's not just about yesterday or tomorrow. We have 11 new product filings in phase 3 in the pharmaceutical unit, 60 clinical trials that are active for new products in MedTech, highlighted by our de novo submission to the FDA on robotic surgery.
What I think is really impressive is that you're giving us actual numbers. I mean, a lot of guys are talking about, look, and I think this third, maybe phase 3, this, maybe phase that, which makes me feel that I can get confident about 2030 numbers. Yeah. No one else has that. Even Lilly, I don't feel confident like that.
Yeah, no. I mean, we're highly focused. Joaquin's done a great job with the management team. We're strong in 3 areas in pharmaceuticals: oncology, immunology, neuroscience, and then in medtech, with the separation of orthopedics somewhere in mid-27. We'll have vision care, we'll have surgery, and we'll also have cardiovascular, our highest growing platform.
You brought up vision care. I have been negligent. Vision care turns out to be one of the great businesses that you're in.
It's unbelievable. We've been the market leader in contact lenses, really propelled by our AccuView One-Day Oasis Max. Extreme comfort, less fatigue for users, but it handles presbyopia and astigmatism all in the same lens. But the real story there, Jim, is just the outstanding performance we've had with some new product launches in our vision surgery space. So cataract is the #1 surgical procedure worldwide. In the U.S., it's about 3 to 4 million procedures a year. Across the globe, about 25 million procedures. By the time we reach 80, about 50% of us will have a cataract, which is really the breaking down of proteins, clumping together, causing cloudy vision. We have 2 platforms, Tecnis Odyssey, Tecnis Pure C. If you want to remove spectacles altogether, go with Tecnis Odyssey. If you drive at night and you have glares and halos, you want to go with Tecnis Pure C. But these have grown close to 10% in 2025.
Now, I was back in San Francisco this week. I was struck by how many acquisitions seem to be done just because companies feel like they have to make an acquisition. That is not J&J way. 2 acquisitions in medtech are extraordinary in terms of taking a franchise and just leapfrogging over everybody else. Speak to those.
Yeah, so Jim, we've done about $54 billion in capital deployment for acquisitions over the last 3+ years. Abiomed and Shockwave were instrumental to really revitalizing our cardiovascular portfolio, building on our strength in electrophysiology. We did another acquisition known as Caplyta, or Intercellular Therapeutics, which has a great asset in Caplyta on the pharma side. Those 3 acquisitions took about $45 billion of the $54 billion.
We should just stop for Caplyta because people are fascinated by this. They're seeing the advertisements.
Absolutely.
This is really something that is changing the world when it comes to depression, which almost everybody has failed. Nothing new in 50 years, Joe.
Yeah, well, Jim, it builds on our 70-year history of working in neuroscience. You were one of the first vocal proponents of a drug called Spravato, which has now helped 200,000 patients worldwide who suffer from treatment-resistant depression. This is our next step in the evolution of neuroscience presence. Caplyta is a drug that modulates the pathways around serotonin, dopamine, and glutamate. It's amazing in that it's indicated for bipolar 1 and 2, schizophrenia, and now recently adjunctive therapy for major depressive disorder. This is a easy to start, easy to use drug, and the way I say that is because it has very limited side effects versus placebo. No weight loss, no impact on lipids, glucose, no reduced sexual function. It is a great drug. It's great for patients. It's also going to be great for our business. We project that's going to be about $5 billion in the coming years.
Extraordinary, because everyone's failed. Everyone. Now let's talk about what's happened with the government. There were a lot of people who felt that when we brought in this most favored nation strategy that the president had, that it would really hurt the profits. It hurt the margins, and at the same time that the big rebuild that he wanted, the onshoring, so to speak, would hurt the out years. It looks like that, if anything, I can put this in the past and in a positive way.
Yeah, I think that's right, Jim. I mean, we had great engagement. Joaquin and the team have really been engaged with the administration even before the inauguration last year. And to us, it's emblematic of how critical they view life sciences as the U.S. being the preeminent country in the world. It's good for economic growth. It's also good for national security. Two different things, though. The investments that we're making, the $55 billion marker that we put in U.S. investment over the next 4 years, starting last year, was really based on solid tax policy that began in Trump's first term with 2017 TCJA. It was then reinforced with last year's passage with the OBBA. That really is the premise for where we want to place our investment. In terms of the MFN deal, as you've called it, we've struck a deal. It actually makes me prouder about the guidance that we were able to put out, because it beat analyst expectations, and they had no idea what the impact from that was. So the American citizens should be applauding the Trump administration. It is worth billions of dollars in reducing drug costs. We'd like to now turn our attention to the intermediaries who really don't put any capital at risk, who keep discounts away from patients. 50 to 60% of every drug dollar from the manufacturers goes to discounts and rebates. Why are patients still paying more?
Well, we know that there are, but without bringing them up, there are some people who are regarded as being attacks in the system. We'll take care of them at another time.
Right.
I do want to point out that there was a time when I'd listened to your call and the conversation would be tout.
Yeah.
I found it very limited this time, and I do want to point out that when you changed your strategy, decided to go after the plaintiffs, is really when you saw the stock go from 150 to 220. Are you sticking by that strategy of going and defending every single case where J&J is being, I'd say, hectored?
Absolutely, Jim. Last night there was a recommendation from a special master to a judge with respect to the Daubert hearings.
Right.
They upheld most of our experts in their opinions. They dismissed a lot of the expert opinions of the plaintiffs' attorneys, but they really didn't uphold their gatekeeping duties that's required by Rule 702 in the Federal Rules of Evidence. That doesn't matter, because the story about J&J and what 99.99% of people at our offices are working on is finding those next cures for cancer, immunology, important devices and medical technology that really make a difference for patients. We will continue to fight these meritless claims. We will continue to aggressively highlight and expose the tactics of plaintiffs' attorneys, the third-party litigation financing, which quite frankly is nothing more than a shakedown, and it undermines American businesses.
I want to end on an extremely positive note. When I think about what you're doing with cancer, I don't see we're going to keep people alive for 2 years and hope that something happens. I'm seeing cures from you. I'm seeing diseases that were fatal that are now maintenance.
Yeah.
These are big diseases, too.
Yeah, and Jim, we had some outstanding data come out in multiple myeloma. So we have 4 products. 8 out of 10 patients who suffer from multiple myeloma are taking a Johnson & Johnson product. We have a product for every patient. Some great data, though, combining 2 of those products. Our star of the portfolio, Darzalex, which is a CD38, and then a bispecific antibody known as Tecvayli. We combined those, and we took hard-to-treat multiple myeloma patients, those who were not responding to therapy, and the outcome is 83% progression-free survival after 1 year.
And we need to point out that
lives.
these are not about to have a loss of exclusivity.
That is correct.
Excellent. I want to thank Joe Wilkins, the CFO of Johnson & Johnson, on still one more amazing quarter. Joe, good to see you.
Thank you, Jim.
Coming up, could the biggest risk to the market in 2026 come from one of the most exciting names of 2025? Cramer's peeling back the curtain to find out. Next.
All this week, I'm on a mission. I want to focus on what could go wrong with this market, not just because stocks sold off hard yesterday. We're bouncing back today once President Trump said he's formed the framework of a future deal for Greenland. I'm just trying to be disciplined. The averages have had a tremendous run for some time now, so you need to consider what might derail this bull market. Okay, look, if the market was down huge these last few years, believe me, it wouldn't be like this. We do the inverse and explain what could go right. There's a lot to consider here, but right now let's talk about the biggest chink in the armor of the massive, incredibly important to the market at least, AI data center build out. It is powering literally hundreds of stocks of all sorts of varieties. It can't go bad. And I'm talking about OpenAI, the sprawling hyperscaler that invented ChatGPT, and it tends to dominate the artificial intelligence world. Now, last fall, we started hearing about OpenAI placing hundreds of billions of dollars of orders with Oracle. That's to build out data centers at NVIDIA, CoreWeave, AMD, Broadcom, Amazon Web Services. Some of these deals raised some eyebrows because companies would invest in OpenAI and then OpenAI would use that money to buy things from them. All right, that's called circular deals. It's not my problem here. Initially, it sent the AI data center stocks into the stratosphere, but Wall Street quickly started wondering how the heck OpenAI would be able to pay for all this stuff. Reasonable concern. They added up, and CEO Sam Altman said they committed to $1.4 trillion in compute spending over the next 8 years. That works out to $175 billion per year just on computing power? Wow. Remember, OpenAI finished last year with a $20 billion annual revenue run rate. Okay, amazing accomplishment, given how quickly they got there, how young the company is, but it's nowhere near enough to cover these bills. Sure, management says they can generate hundreds of billions of dollars in annual revenue by 2030. But that's so far above the numbers that they're putting out now that it's hard to put much faith in that forecast, although, of course, I want to believe. You know what? It didn't help that his CFO, Sarah Friar, threw around these comments at a Wall Street Journal conference about a possible government backstop last November if things got tight. Those comments crushed the entire group again. Even though the company ultimately walked back the comments, you never want to contemplate that a company you might invest in could need a government backstop. There's a reason that so many of the major AI data center stocks actually peaked in late October or early November. OpenAI had been the driving force behind much of the last year's AI rally, and it had become a question mark of their own doing, frankly, and that was the top of many of the AI arms dealers. Then in mid-November, Alphabet released its latest AI model, Gemini 3, which quickly became regarded as the best in the business by a lot of us who just heard, a lot of reviews. Reviews were positive. Alphabet had been counted out because doubters couldn't imagine how they could prevent Gemini from cannibalizing Google search. I was one of those doubters. But they just put the search results out on the same page. Problem solved. Gemini right next to it. Look, you just got to go see it. I promise you might switch. And there's a good chance that you'll switch from ChatGPT if you go to Gemini. I have. We have to ask, if OpenAI's no longer got the best generative AI platform, can we really count on them to make enough money to just cover their spending commitments? Logical question. The truth is, these guys were always going to have to raise a lot of money to pay their bills. The only question is how richly their stock will be valued. In December, OpenAI got a $20 billion plus cash infusion from SoftBank to complete a funding round from March of last year. Later that month, we started hearing that the company was looking to raise $100 billion in another private funding round, perhaps at a valuation of more than $800 billion. There's also been chatter that they might be considering a very, very large IPO, but CFO Sarah Friar shot that idea down back in November. I doubt they'll do an IPO anytime soon, and if they did, I bet they would have to reveal a set of its financial results that would show significant losses, very negative cash flows. Frankly, I'm just not sure that the public investor really would support the deal right now, especially if they're trying to raise hundreds of billions of dollars. Now, with the new year, we've gotten some additional news on the OpenAI situation. Some of it's actually good. Not all of it, though. Let's start with the positive. This past weekend, Sarah Friar, that's that CFO, published an update about the business, including some new financial details, and there were some great numbers in here. Both weekly active users and daily active users continue to produce all-time highs. While their compute spending has skyrocketed, their annual recurring revenue has grown at the same pace, which suggests they aren't wasting their money. This year, Friar says their focus is on practical adoption, meaning finding ways for real-world industries to harness their AI platform. That's encouraging. I thought the exposition, frankly, was brilliant, like its author. And it gave me conviction that OpenAI is thinking big and won't just be a business-to-consumer operation. As for the more negative news, though, two things really stood out. First, we continue to see more and more interest in Claude Code, another rival. This one is a product from OpenAI's and chief, I'd say, well, let's say that they're not they go against each other pretty hard. How about that? I'm trying to think about it because I don't want to call it. These guys are all kind of prickly. I don't know if you know that. Anthropic is a very good business-to-business site. By the way, Claude Code is one of the reasons why most enterprise software companies have continued to get hammered in the new year, because it is so good. I asked it a question. I literally wrote a program. I couldn't believe it. I don't know how to write a product. It's easy for me to write a Netflix program. In other words, Anthropic's Claude has emerged as one of the most favored AI platforms for the enterprise, at the same time that Google's Gemini is increasingly seen as the best AI platform for the consumer. So where does that leave OpenAI? I honestly don't know, although we know OpenAI has its eyes on the enterprise market, as I mentioned. How about the second negative development this year? This one I really don't like. It's a long-standing lawsuit from Elon Musk, who co-founded OpenAI back in 2015, when it started as a nonprofit venture, and it's starting to look like it could be a major problem for the company. Earlier this month, a judge ruled that the case could proceed to a jury trial, which should start in late April. According to a court filing from last week, Musk is seeking up to $134 billion in damages from OpenAI and its partner, Microsoft. I'm calling that negative. Thousands of pages of evidence from the case have been unsealed this month. And speaking of someone who went to law school, some of the details in here look pretty suboptimal for OpenAI. The company already sent letters to the investors warning them to expect, quote, deliberately outlandish claims, end quote, from Musk. There's an old saying, don't get into a pissing contest with a skunk. And that's exactly what this lawsuit feels like to me. I usually don't use that saying, but I put it in. So as we begin 2026, here's what I'm thinking about OpenAI. First, I have a pretty simple question. Can this company complete the private fundraising round that was rumored in December? OpenAI wants $100 billion, the largest private funding round in history. Was when these guys raised $40 billion last year from SoftBank. The largest IPO in history was when Saudi Aramco, Saudi state oil company, raised just under $30 billion in 2019. So, I mean, it's not going to be easy for OpenAI to raise $100 billion no matter what. Then, of course, there's the question of whether or not they can get a valuation near what's been rumored, call it $800 billion or more. If OpenAI can truly raise $100 billion at an $800 billion valuation, do you know what? I think the whole data center complex could really get going again after a 3-month pause. But what if investors insist on a lower valuation, say $500 billion, which was the last valuation used in October for a secondary sale? No confidence inspired. Beyond fundraising, we need to see OpenAI make even more progress on the revenue growth front. Otherwise, its optimistic long-term forecast just won't seem credible. And I say that fully knowing that OpenAI's revenue growth is astounding. So here's the bottom line on what I think is probably the biggest issue for 2026. OpenAI has become the Achilles heel of the AI data center complex. If it can raise enough money, then I'm betting the whole group can roar and the taunt of Achilles will disappear. But if OpenAI can't raise that money, if they keep losing money and they keep losing share to Gemini and Claude, or if they lose the lawsuit to Elon Musk, well, that's real bad news for the many data center companies that are relying on OpenAI for a big chunk of their orders. I think nothing is more important for the success of the AI complex than OpenAI, but there are enough question marks to make me more cautious than last year. And as I intend to say at tomorrow's Investing Club meeting, there are many other sectors that might be more attractive if this company lets us down. Let's go to Lanai in Florida. Lanai.
Booyah, Ski Daddy, second-time caller, long-time listener. A huge
I am glad you're calling in.
All you've done to make me a better investor.
Oh, thank you. That is the goal. It's a simple goal. I was telling my daughter that yesterday, Lynn. I said, look, I want to make people better investors. If they make money, fantastic. Let's go to work.
All right. My stock is Motorola Solutions, ticker MSI. I've owned it for years, and it's had a nice run, but it's backed off. What are your thoughts? Buy or sell?
I think Greg Brown is doing a terrific job. I like the company very much. I have to tell you, I thought they were going to give Axon a run for the money. I'm actually not giving up on that. I think it can still happen. And thank you for the kind words. I'm really focused on this in 2026. We are going to make you a better investor or else. All right, OpenAI is the Achilles heel of the data center complex. If something goes wrong for them this year, then the whole group is going to suffer, and then maybe the whole market will. Much more on Money Ahead, including my continuing series on what, like we just heard, could go wrong. This time I'm going to focus on the potential introduction of new supply of stock, something I'd like to think I'm a bit of an expert on. I'll reveal what the risks are to your portfolio. Then I always say discipline trumps conviction, but for one area of the market, it's been, well, let's just say it didn't come out the way I'd like. I'm going to explain why. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. Yesterday, we got hammered, but today the market came roaring back after President Trump promised that he wouldn't try to take Greenland by force, although he still wants it and may have a treaty in hand without new tariffs, which apparently all we need to do to get a rally going. Still, I think it's worth considering what could go wrong for a market when we're still not too far from the highs. That's why I've been highlighting potential issues all week. Now, though, I want to focus on something that's historically been just lethal to the bull market throughout history. I'm talking about a supply shock from a wave of stock offerings. Remember, at the end of the day, the stock market is above all a market, and markets are controlled by supply and demand. If you remove supply through mergers and buybacks, it helps the averages levitate. But if you flood the market with new supply from stock offerings, sell, eventually there's not enough money to sop up the supply, and we go lower. After the big run that we've had for the past 3 years, including extremely frothy action we've seen in the past few weeks, my biggest worry about new stock supply comes from existing companies. We've seen huge runs in speculative stocks that make little or no money. Those companies will all need to raise capital eventually, probably through secondary offerings. And the best time to do that is when your stock is flying. For example, let's do this. Check out Resolve AI. It's a British company that says it's developing AI software for e-commerce, but one that's still a long way from profitability. Like I mentioned last night, Resolve pre-announced some solid revenue numbers last week, and the stock caught fire. Coming into this past weekend, it was up nearly 80% year to date. But that's no longer the case because yesterday morning, Resolve announced it's selling 62.5 million shares at $4 each, raising $250 million in gross proceeds. That $4 price was a 13% discount from Friday's close, and the stock ultimately plunged 23% yesterday. Before losing another 1.4% today, the big gains of the past week, okay, they've completely disappeared. Of course, sometimes companies are more subtle with their fundraising. Instead of selling stock, they'll sell convertible bonds that can be transformed into equity at the owner's discretion. Just look at Strategy. That's the old MicroStrategy, which has borrowed a lot of money to turn itself into a leveraged Bitcoin play. Strategy's done that through convertible bonds. They often issue zero convert bonds, meaning they don't even have to pay interest on them. And with conversion prices that are well above the spot level of their shares, Strategy's share price has come down a lot over the past several months. At $164 today, it's down 64% from its 52-week high last July. The main reason is that Bitcoin's come down, but it doesn't help that there are all these convertible bonds floating around that could turn into stock maybe sooner than you think. The next source of the new supply comes from insider sales, meaning when top executives, board members, or large shareholders sell stock in their company. These insider sales have to be disclosed via the SEC filing, so you can monitor them, and when you see it, powerful warning sign. These are the things I worry about. Of course, we haven't seen a ton of secondary offerings or insider selling in the past 3 weeks. Still, I'm watching it. Finally, let's address the big source of news of stock supply that I'm most concerned about that could be coming later this year, the IPO market. Do you know that the IPO market is maybe my number one worry for 2026 because it's going to be so big? I expect the IPO market to keep recovering in 2026. Last year, we had just over 200 deals, collectively raised $44 billion, according to Renaissance Capital, the IPO research firm. This year, the same firm expects 200 to 230 deals, raising $40 to $60 billion. If Renaissance is right, then the market will be fine. You know why? Because $60 billion is actually not enough to overwhelm us with supply. I like that. My concern is that we could have a wave of colossal deals later this year. Companies like Databricks, they've been on our show, the data storage and analytics company, or Elon Musk's SpaceX, or this Anthropic, the parent of Claude, or even OpenAI, although I think the latter is unlikely. Still, those are 4 of the largest privately held companies in the world. So if any of them comes public, we're talking about some of the biggest IPOs of all time, a deluge of stock. Databricks was valued at $134 billion in a private fundraising round just last month. SpaceX was valued at $800 billion in a secondary sale last month. Anthropic's reportedly working to raise money at a $350 billion valuation. Typically, in an IPO, a company sells roughly, say, 20% of its shares to the public. But even if these companies only sell, say, 10%, you're talking about $128 billion in stock issued from just Databricks, SpaceX, and Anthropic alone based on those valuations just cited. And that is a very positive way to look at it. These 3 could raise proceeds that are 2 or 3 times higher than what Renaissance expects for the year. And for what it's worth, $128 billion is not that far from the record $142 billion in total IPO proceeds from 2021. Not a good thing. By the end of 2021, the market eventually ran out of steam, and we had a brutal correction that lasted most of 2022. The flood of supply from those 2021 IPOs and that horrible wave of SPAC mergers was a major contributor to the end of the bull run. Again, this isn't something that's going to happen overnight. Maybe none of these huge privately held companies decide to come public. Maybe the deals only happen toward the end of the year, but it might be sooner than you think. Just today, the Wall Street Journal reported that Elon Musk wants to complete a SpaceX IPO by July of this year because he's trying to get ahead of the Anthropic deal. The article also said that Musk wants to raise money in order to build data centers in space. Whatever. For now, just know that these potential mega deals present a real risk factor for later this year. Because in order to raise cash to buy newly issued stocks, giant money managers will typically have to sell something else, and that will put downward pressure on the entire market. What happens? Your best stocks, which you think everything's fine about, may get sold down just so the big funds can raise enough money to buy Databricks, Anthropic, and SpaceX. Bottom line, when stocks soar, the market often gets hit with a flood of new supply from secondary offerings, from insider sales, from IPOs. The flood hasn't hit yet, and we don't know how serious it will be. But there's a very good reason to believe that it's coming sometime this year, so keep your eyes open. Oversupply has killed many a bull. It could always do it again. Mad Money's back after the break.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
Play this out. And then the lightning round is over. Are you ready? Ski daddy. Tell me lightning round. Let's go to Ian in California. Ian.
Hey, Jim. Booyah!
Booyah, Ian. What's going on?
Well, I'd really like to know what you think of Serve Robotics.
Okay, we're not going to go into robotics other than to say that we want Tesla. I know Tesla's done nothing. I heard that 100,000 times today, so maybe it's time that Tesla did something. Let's go to John in New Jersey. John.
Jimbo, how you doing today, buddy?
All right, partner, what's shaking?
Okay, so I called you before about this company. You weren't sold yet. That's okay. I didn't cry about it. Now, Eric Jackson and Anthony Pomp have drilled into the open army. We keep swinging. There's no quit. Now, Pomp is dropping an interview with Kaz tomorrow. It's going to be electric. You got management that's all in with performance pay, $1 million open market buys from the boys himself. There's no hype here. There's all, this ain't hype. It's a real company. It's a real mission of tilting the world back to home ownership. Homes have been frozen. Open door is going to melt it. Jimbo, give me
door. Okay.
a booyah.
Now, okay, so listen, good John. See, I wrote this book for you, all right? The reason I did is I said you can own one of these stocks. You can own a wild speculative stock that company doesn't make money because you think about all those things in a pomp and a circumstance. Here's the issue. That's the one. I don't want you to own a lot of others, okay? But I'm going to say you can own that. No one else, by the way, in the history of the Western world would actually endorse that except for me. And let's at least get that done. Let's go to Terry in Florida. Terry.
Hi, Jim. It's Terry, Port Charlotte, Florida, club member.
All right.
I bought this stock about a year and a month or so ago, and it's down 55%. The 50, 150, and 200 moving averages are all pointing down about 45 degrees. I'm wondering if I should just dump it here or buy more and hold for the long term. The stock is Fiverr International, FVRR.
You got to hold it because it doesn't lose money, but it is the most commoditized stock that I've been asked about this week, and this is a week of great commodity. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, the memory chip market has been a rocket ship this year. So, should you buy in? Cramer's discussing whether it's too late to get on board. Next.
Discipline trumps conviction. That's been my watchword for decades, and it saved me millions of dollars over my 44 years of professional investing. But every now and then, discipline becomes a real killer. Right now, when it comes to the semiconductors, especially the commodity semiconductors, discipline's been a horrendous tactic. I want to confront that tonight. First, the visceral side. Every day I come in and I watch the stocks of Micron, Western Digital, SanDisk explode higher. All the moves are parabolic. It's one of the greatest runs of all time. They have no quit in them. That's agonizing to watch when you don't own them. And I don't own them for the charitable trust because I don't chase. I know it's a sucker's game, or at least it has been. Chasing these stocks has historically led to big losses as you tend to come in late and then get hammered as buyers turn holders and holders turn sellers. Historically, it's better just to admit that you were too late and wait for a better moment. But all this discipline and thoughtfulness has failed me with the memory stocks this time. History says these commodity tech stocks follow pricing, so they can go higher and higher and higher, but ultimately they peak and pirouette and flay you alive. Until this move, there's never, ever been a time where pricing has gone up so far so fast. I can recall, say, a 300% increase in pricing between 2016 and 2018 for a sharp decline totally gaffed you. That's a huge move, but the decline seemed just as sharp. This time, we've got an astounding unheard of 400 to 500% move in memory prices. No peak in sight. Why is that? First, the explosion in demand from artificial intelligence is so huge that companies like Micron, Seagate, SanDisk, and Western Digital are going full out, just trying to meet the demand. They can raise price at will, though, because demand has completely overwhelmed supply. As someone who once owned 5% of Western Digital 35 years ago, I always thought this could happen. That's why I took such a big position. But it failed me back then as a hoped-for shortage never materialized. Too much supply. I was lucky to get out alive. This time, the company can't keep up, and the marketplace is so desperate that there's seemingly no price that they won't pay, hence the big gains. Last week, Micron broke ground on a $100 billion facility that will produce its highest-end chips. They won't be producing those chips, though, until 2030. And not much of a help if you want memory to get cheaper. In the past, when we had these spikes, the semiconductor capital equipment makers would go all out and come up with what's necessary to make a ton of money, even if it alleviates the shortage. But the companies that make this kind of machinery aren't up to the task either, because they, too, have never seen anything like it. So buyers are taking up Applied Materials, KLA, Lam Research every day because their stuff is in short supply, too. As long as there's a machinery shortage, the memory shortage isn't going anywhere. Hey, look, they weren't clueless. Even a couple of years ago, there was a huge glut of these kinds of chips. They had a long boom-bust industry history. I don't think it's changed, but try telling that to the people who've ridden SanDisk up 111% this year. Of course, there are other companies that make the memory chips. There's SK Hynix, Samsung, Korean giants that are both dominant players. When I tried to ride these cycles before, I got blindsided by those two companies having more supply than I thought. They're pretty darn secretive, causing these markets, to go into equilibrium and then just to outright crash. Hasn't happened this time, though. It would be annoying to watch these rallies if they kept to themselves, but these products tend to go into a lot of different end markets, mostly pertinent PCs, servers, cell phones. As the memory makers go up, their customers' earnings go down, which is causing a lot of weakness in Dell, HP, and yes, you've wondered, Apple. That's why it's been going down. It's been eating into their profit margin the whole time. That's why Apple's been such a lousy performer. Can you get in on a temporary downturn? You can try. But I hesitate to recommend it because we don't know what Hynix and Samsung are up to. That first decline might be the big precursor. That's why, in the end, I have to stand here and suffer. I missed it. I regret it. I got it wrong. Maybe there'll be a moment to buy some Micron or AMD at a lower price. I like the latter. Or maybe there won't be because I don't chase parabolic, all right? I don't usually have to suffer the consequences because I don't. But I still stick with my discipline because every time I've abandoned it, it's blown up in my face. And I'm not going to risk it to catch what could be near the tail end of this incredible rally. I like to say, as always, bull market summer. I promise I'll find just for you here on Mad Money. I'm Jim Cramer. I'll see you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC or its parent company or affiliates and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.